We have an institution running the whole economy, which is based on lies. So we anticipate the crisis to start sometime next year. A lot of European banks cannot withstand a recession.
Please join us for our next live stream, Sunday, January the 19th at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be Sunday, January the 19th, 9 p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Once again, if you are new to this channel or you have not already done so, please do subscribe. Click on the bell to be notified on new updates, and do give us a thumbs up. If you like what we do, we appreciate your support. Today's guest, Toumas Malinen, who is the chief economist of GnS Economics and an adjunct professor of economics at the University of Helsinki. His current research interests include economic growth, business cycles, economic crisis, monetary unions, and income inequality. And we are delighted to have him here today as our guest. Good day, Tuomas, and welcome to SBTV. How are you doing?
Fine, thank you. And I'm honored to be here.
Oh, we're honored to have you, and we thank you for taking time out to be here with us this morning for you. Tuomas, I like how you're specialized in economic growth, business cycles, economic crisis, monetary unions, and income inequality. We've had a lot of discussions in these areas with past guests on our channel. May I ask, when did you start researching into the business cycles and economic crisis, and what got you interested to specialize in these areas?
Well, basically, the interest in crisis, I think it got, I kind of got idea of that from the early 1990s depression of Finland, actually. So I was a teenager back then, so it was a very traumatic experience for whole Finland. But in my academic work, it was the 2008 crisis. So that's when I kind of changed my main view. I was doing a PhD on a dissertation on the relationship between income inequality and economic growth back then. So I'm a trained growth economist from the start. But the 2008 crisis got me going, and then actually the European debt crisis in 2011, 2012 got me interested on the monetary unions and stuff like that. And the business cycle basically came in when we started the GnS Economics, the forecasting firm I lead in early 2012.
Okay, you mentioned right around 2008. I'm not sure if maybe you started after it or before it, but if it was before, did your research forewarn you of the 2008 financial crisis, or did the gravity of that crisis kind of take you by surprise?
I think my biggest kind of mistake during my PhD studies was that I was rather confident already in 2006 that something bad was coming. I let my colleagues know it all my co-students basically, but I didn't write it down anywhere. That kind of bugs me because I was kind of right on those, but the severity didn't really surprise me. Actually, I was very well informed of the problems in the CDO market. Before the crisis, it actually shorted the U.S. stock market in early January 2008 with every penny I had and could borrow. So I was anticipating that. What kind of caught me by surprise was kind of the response of the global authorities. It was a far more far-reaching than I would have suspected.
Yeah. Okay. After the 2008 crisis, lawmakers and regulators supposedly introduced a lot of regulations and implemented actions such as QE to prevent sort of a repeat of this type of a crisis. Has your research showed that the banks and financial institutions have learned their lessons, or is our financial system safer today or in a bit of a more precarious position?
The first thing is that it's really difficult to say beforehand what the banks have and have not learned. That's what we know from the history of finance innovation. But for example, banks do learn, like the 1990s financial crisis of Finland taught our banks to keep away from these exotic financial products. So basically, in the Nordics, when the 2008 crisis hit, our banks were basically harm-free. They didn't have any bigger problems because the 1990s crisis and how it was handled, it was a very, very strict, or it was a punitive recapitalization, what was done in the Finnish and Swedish and Nordic, Norway banking sectors, basically. So banks do learn. The other kind of a big lesson from financial history is that your regulations are always running behind of financial innovation. And what the legislation put in place after 2008 did, in my opinion, is that it actually made the banks weaker in a sense that they became less profitable. And I know this is kind of a heretic view, but it's something that people don't really realize, that the banks do not fail because the capital fails or they don't have enough capital. They fail because the trust on them is lost. So I don't really think that the legislation introduced after 2008 has made banks safer, but it may have made it more easier to handle the crisis because now we have the legislation for example, the deposit bail-ins. So banks in US and in Europe can use the deposit money to recapitalize themselves, and this was done in Cyprus in was it 2014? So, and this is something that people don't really realize, that there is the possibility that when you take the money, your money into the bank, and if a crisis comes, you will not get all of your money back. So it kind of introduced a depositor risk for normal consumers and businesses.
Okay, but if you could distill the cause for the troubles in our financial system today to a single root cause, what would it be?
Central bank policies.
Good one. So, okay. Referring to interest rates or?
Interest rates, QE, and all the meddling they have done, basically. So, and the thing is that what people don't really understand is that during the past 2 years, there have been 4 global market bailouts of central banks. So this is something that has never been done before. Like for example, the policy of Alan Greenspan, the former head of Fed, was to let the markets correct or crash and then clean up after. But now, like we saw in a year ago, the Fed got panicked with the falling stock and credit markets and pivoted. And well, of course, it had to kind of bail out the repo market in September, but these are things that the central banks have created an financial environment that cannot sustain shocks. And that's extremely troubling and worrying, because financial systems should be robust to shocks. But now central banks have made it such that it cannot. And that is a dangerous thing that should worry us all.
Yeah, you touched on the repo market. I've been hearing the Fed is the repo market. Do you think we are ever really going to have that overnight market go back to the way it was, or is the Fed really in there indefinitely at this point?
I don't think central banks are in anywhere indefinitely. When the recession comes, the capital markets will correct, which in this case means they will crash, and the blame will be placed on the central banks. And they will be either gone completely or diminished considerably within the past 10 years, or their powers will be diminished. So I don't think Fed will be there. And I think people put way too much trust on the liquidity alone, like the central bank liquidity. So real economy is really the thing that eventually determines the fate or the valuations of the asset markets. So where the real economy goes, the asset markets will eventually follow, and this time will be no different.
Okay, I'll get back to the repo market in a bit. Bubbles. The U.S. is still in the midst of an unnaturally long business cycle. Some of the other guests on our show have pointed out that never before have we had such a boom where interest rates are very low and the prosperity from the boom has not permeated to the economy and the man on the street. In your opinion, what's fueling this business cycle, and is it a boom period supported by good economic fundamentals?
Well, on the latter, no, absolutely not. But I think this has been a combination of in the U.S. That is, it has been a combination of kind of a nascent recovery and central bank and political support. Yeah. So the thing is that in my thinking, as a trained growth economist, is if you have a very depressed recovery, let's say, it might last longer than many think, especially when it's supported constantly by the low rates and then tax cuts and all this kind of stuff. But it's not really an organic growth we have seen. It's been something mutated, very, very unnatural and unhealthy. So that's also one reason why this business cycle is so long.
Yeah, I guess there's been a lot of fertilizer going on, Fed fertilizing everything.
Yeah, for sure.
But do you agree with the Fed Chair Jerome Powell that there's nothing that's really booming now that would want to bust? Do you see bubbles that are at risk of popping now?
I don't actually. Now that you mention it, I haven't. Has Jerome Powell said something similar after the repo markets break up in September? Did he say? I know that he has said this. What you said, but has he said it after the repo problems started? Do you know?
Oh boy, I'm not sure.
Yeah, because if he has, then he has no idea what he's talking about, or he's lying, basically. So, but we consider the repo problems as the first sign of this over leverage and fragile capital markets coming to kind of a head. So we have this everything bubble, basically. So every single financial asset, or the value of the financial asset, has been raised to very high levels due to the constant central bank support, which is the low rates and the QE programs. So we have bubble, and it's everywhere, which also makes it a bit difficult to see for an untrained eye. But central bankers should know better. But of course, they cannot say it. They cannot say, no, yeah, well, there's actually this, everything bubble, and we caused it. Sorry, no, they cannot say that. So they deny it. And we have I think people should consider it a bit more, that why we have because the thing is that central banks, they have the mandate of financial stability. And it requires that the public trusts on the financial system and on the central bank and the economy. And what this entails is that if things are not looking good, central bankers basically need to lie to convince people. And people don't really think this enough. This is a big issue, undiscussed issue, agreed by every single central banker I have ever talked privately. So in private conversations, they say this is true. Publicly, never. And we have a system, we have an institution running the whole economy, which is based on lies. And that's, I think that's a sick thing. But we definitely have bubbles.
Yeah, I agree. I think every time Jerome Powell comes out at the FOMC meeting or anything else, if he's wearing a lavender tie, it's going to be a lie. So
okay,
it just seems to be it.
Yeah. Okay. Yeah.
But Tuomas, how do you view the stock markets, like the Dow Jones Industrial Average, reaching all-time highs? What is it, every week now? Seemingly, is this loose monetary policy fueling these stock markets?
For sure. That and I think the optimism that President Trump and the central bankers have kind of cooked up is the other explanation. So we have this we call it artificial liquidity from the central banks going into the markets. And then there has been this kind of a false sense of economic boom, which actually never did came in that magnitude that as President Trump promised. So investors have been very bullish. But this latter stage since summer basically has been just manic. There is absolutely nothing in the real economy that could say that this is a sustainable rise.
Yeah, I've been hearing the term a lot about zombie banks, zombie companies. I think the longer we keep these zombie entities alive, the more it's going to drag us down when the day of reckoning comes.
Yes, sure.
The crisis in the Eurozone. In the GnS Economics blog post titled Towards the Crisis, you wrote that negative rates and QE have wreaked havoc on the profitability of European banks. For the benefit of our viewers who may not be familiar with the situation over in the Eurozone, can you explain what you meant by this havoc that you see?
Well, it's been the thing is that when you have negative rates, they cut they kind of let's say it this way. When you have very low interest rates, it starts to hurt the profitability of banks. But when they turn negative, it kind of flips the whole logic of how banks make profit in over. So it makes it kind of corrupts the whole idea. So banks lend long and borrow short, basically. So you have deposits and they loan. And when the rates that the central banks set go to very low negative, this kind of earnings logic goes haywire. It doesn't work anymore. And Europe has been in negative rates for over 5 years. Our banks were not recapitalized after the 2008 and 2012 crisis. So we have a massive amount of zombie banks. And what the authorities in Eurozone actually did is that they allowed banks to keep these toxic, nearly worthless assets in their balance sheets and pretend that they still have some value. And so we have there's a kind of it's a kind of really problematic combination that the European banking sector faces. The first thing that we didn't take care of the banks after the 2008 crisis, and then every decision basically made by the ECB and the legislators have made their situation worse. So it's a really difficult combination of a kind of failed policies and wrong incentives that has led to the European banking sector to its current bad state. Now I notice that it's a bit difficult to explain. It seems, in a simple sense, but it's just failed policies basically what has run our banking sector or made it so fragile that it currently is.
Okay, some of those countries, Portugal, Italy, Greece, Spain, have they recovered enough from the euro crisis from a few years ago to justify them issuing debt with those negative rates?
No, of course not. It's a sick joke, basically. So there's a research paper published on the Bank of Netherlands side 17. I mean, at the latter part of 2017, which found that the quantitative easing programs of the ECB has pushed the prices of all Eurozone governments to unnatural heights. So we have a massive sovereign debt bubble in the Eurozone. So no.
Okay. How about these negative rates? Are they impacting individuals within the Eurozone?
Yeah, I'm sure they are. The banks haven't been able to transfer them to their consumers yet in a larger scale, but I think they do. We just don't understand it really clearly what it does, but it does corrupt our thinking, our economic thinking. If one has to pay for deposits and receive funding, receive money from lending, it's just it destroys the time value of money, and I don't think we really understand what it does
Yeah.
yet. So it will take some time before we can see all the ramifications, and it probably requires a lot of studies to be made on the subject. So that so I think when the crisis comes and we start to look for the reasons and explain all the stuff that happens, I think the macroeconomic field will be very interesting to place to work during the next 10 years, maybe. There's a lot of research to be done.
Yeah, I hear you. People, they're becoming seemingly more and more immune to the news of central bank money printing and continuous debasement of currencies. Do you think people will also become immune to this outrageous notion of negative rates in the future?
I don't really think that the negative rates will be with us so long. This is because we anticipate the crisis to start fully sometime next year, and it will take also the central banks with it. So we consider that the negative rates are here only for a short period anymore, and then when we go back to the rates set by banks, mostly they will rise quite considerably. So there will be massive defaults for sure.
Okay. Tuomas, can you tell us a bit about this new global banking crisis that you see starting from Europe, and you're saying it's all but guaranteed?
Well, yeah. It's the thing is that when we talked about the situation of the European banks, which is rather dire, the recent stress test of the ECB basically showed that a lot of European banks cannot withstand a recession. They didn't write it like that way, but they stated that the many banks could not handle if big institutional clients pulled their funds and their interbank funding would become less available. Yeah. And this all happened in a recession. And the thing is that what people don't seem to understand, not even in the US, is that Europe has the biggest concentration of global systemically important banks. So every problem we have in the banks here will be transmitted throughout the globe. So if our banking sector is currently about, well, the estimate's going to vary, but it's about 300% of Eurozone GDP. It's a massive beast, kind of. So when our problems start in the banks here, they will spread like wildfire, that's for sure.
Yeah, okay. I think one of the banks a lot of people are concerned about in your neck of the woods is Deutsche Bank.
Yep.
Yeah, okay.
Yeah, it is. And if you look at their stock price, it hasn't, over the year, it hasn't gone anywhere. While, we had this massive stock market boom and many European banks have seen their stock prices rise, and Deutsche has not gone anywhere. Yeah. And that is scary, to be honest. So it's a teetering giant, really. And when it goes, or if it's taken over, or whatever its fate becomes, it will be a shock to Eurozone, and that will start it all, I think.
Yeah. Okay. We touched on the repo market a little bit earlier, and I'd like to get your take on that recent U.S. market liquidity crisis. In your opinion, what do you think caused that liquidity crisis?
Well, it's a combination of factors, basically. But there's two kind of main components. First one was, which we detailed in the blog a few weeks ago, which has been gone kind of unnoticed, was that the QEs, what they did, that they pushed excess reserves or the balance sheet of banks. They really pushed them. The banks would have never acquired such a big amount of excess reserves. And this altered, of course, it altered the balance sheet and also altered their assessment of the risk and how they get, profits up. And so it encouraged them to a riskier lending practices and also to holding riskier securities to increase profitability. And when the QT started, that quantitative tightening, where the Fed rolls off the assets, from the balance sheet, and thus on the balance sheet of these primary dealer banks, they switch those holdings to treasuries.
Yeah.
So there is a they hoard the treasuries, like they Kolanovich in the damn, I forgot the bank he's from, but anyway, mentioned in his note. And there was another development was that hedge funds seem to have used the repo to increase the leverage, and they do it basically by buying a treasury, lending it to the repo to get more get funding, and then buy another treasury, lend it to back to the repo. So they kind of created this leverage loop, and they then there were some regulatory issues which demanded that the banks hold largest share of cash. And in September, there was also a treasury, the U.S. Treasury, filling up its coffins from the. Well, they had the problem with the debt ceiling, and Treasury used a lot of its available funds or cash, and so they, acquired it back. And all these developments kind of led to the thing that in September, it seems that the trust of the primary dealer banks on the counterparties in the repo market just vanished, and we had this problem. And then the Fed stepped in. But the thing is that it seems that the trust, especially on the hedge funds operating in the repo, is the one that was lost. So basically what the Fed is now doing, it's supporting the leverage hunting or leverage increasing of these hedge funds and private funds in the repo. And if this is really so, then the system is really perverted. So, but that's basically how we see the repo problems at the current time.
Okay, Tuomas, excuse me, I've been following the repo market, and not an expert in it, but what I've noticed is we all say the Fed is taking in the treasuries and whatnot, but what I've noticed is they've been taking in a lot of mortgage-backed securities, and it was basically at like 3 billion, and it's over 20 billion now. Every once in a while on a day, like last week, there was a time last week, I believe it was 24 billion, but you don't hear anyone talking about some of those treasuries or securities being mortgage backed. Well, why do you think they're not really saying anything about mortgage backed, or is this something that we should be concerned about?
That's a good question. I don't know. We haven't actually thought it that way. That's a very good point. So I don't know, but it's interesting that they don't really speak of it. It really is. Okay, moving on. Let's see. In a more recent blog post titled "Into the Abyss," I like the names of these articles. You wrote that CLOs, collateralized loan obligations, this market is another canary in the coal mine with regards to a financial calamity. Can you share with us what you see with these CLOs? Well, I think we mostly consider them as a trigger for the over leverage system. So it can be one place the kind of unwinding begins. So we don't see them like, for example, collateralized debt obligations of which were in the heart of the 2008 crisis. They're kind of a different things. CDOs had a AAA credit rating, and CLOs are usually constructed of poor debt and poor quality debt, and they don't get as high credit ratings, at least that we know of. So it's more of a localized problem in a sense. We think that the CLO market, but it's so big that when the downgrades start, there might be a kind of an investor rampage out of it, which could set the spark for the bigger unwinding in the global capital markets.
Okay, so should we be worried about these CLOs the same way we were worried about the CDOs after we found out what was happening, or
not the same way, but worried nonetheless?
Okay. Given that we're staring down an oncoming crisis once again, what do you think people should be doing to better, let's say, survive this crisis?
Well, there is a simple rule of three: pay back debt, debt, hold cash, and physical gold. That's our simple mantra. There's not really much one can do, and acknowledge that if you have a large amount of deposits in banks, some of them may be confiscated. So try to look the banks you consider know to be safe, but prepared for the possibility that some of that some of the money in the banks will not be given back.
Yeah. You mentioned gold. How do you view gold and its utility today?
Well, we did a kind of extensive analysis on the different asset classes, how their prices have behaved in crisis. This was our June 2019 Q review report, and basically it showed that considering the severity of the coming crisis, physical gold may be the only few asset classes that can really hold value and that will be liquid. So we consider as the most important crisis hedge at the moment.
Okay, most important crisis hedge. I think we should all remember that. But Tuomas, before we wrap up, can you tell us more about your work with GnS Economics and what you're working on now?
Well, we are a economic analysis and a forecasting startup that's run by 6 partners. And I'm basically the only public figure. We thought that it's better to have just one people in the public eye. And what we basically do, we aim to combine the most recent academic research on economic recession and crisis forecasting to this insightful and sound analysis on the financial markets. And we just published the very hefty report called Into the Abyss, which we detail the coming crisis, which is a special report on the economic collapse of 2020-2023. Oh. So when you're asking what we're doing now, we're kind of recovering of writing that, having a close eye on the markets, but trying to have a small Christmas holiday and then start to prepare something more something more, some deeper analysis on the early next year.
Yeah.
But we are not at the moment. We are not working on anything specific. We're just following because we are going in a very delicate phase now. Basically, you have to follow every development in the market.
Yeah, I completely agree with you there. How can our viewers follow your work, your website, or maybe a Twitter account that you have?
Yeah, Twitter would be the best, and also I urge everyone to go check our webpage. There's a lot of free stuff too, and several services, and some of our older Q review reports are also free. So I urge everyone to go and check there. But come and follow me on Twitter. I'm very active there. So if you want to be scared of the coming problems, then you come to follow me. Currently I don't have very much soothing words for anyone distributed in Twitter or anywhere. So, but it's just that we saw the situation as so dire that there's really nothing you can do to, fix it. So we are heading to a crisis. There is no matter what, basically.
Yeah, no worries there. Our viewers, they want truth. Even if sometimes the truth hurts or is a bit worrisome, they just want to know the truth. So we appreciate you giving us your views and your opinions, and I'll be sure to send people to your website and get you to follow you on Twitter.
Thank you. It was very nice talking to you.
It's nice talking to you also. We'll see you again, and you have a Happy New Year.
Thanks. You too.
That was Toumas Malinen, CEO of the GnS Economics, sharing with us about the coming banking crisis in Europe. To learn more, please visit gnseconomics.com. If you like this video, please hit the like button and subscribe to the SBTV channel to be updated on new content. And do also check out the SBTV podcast on iTunes and Spotify.